Great. Well, thank you very much, Yong Heng. I was thinking before the talk today. I was trying to count up the number of times I've been to Singapore, and I think it's 10 or 12 times now, and over the past 15 years or so. And it's really been wonderful to see how NUS and NUS real estate has gone from nearly great to really great in everything they do, as well as to see how Singapore as a city has done exactly the same thing, gone from nearly great to just a model city that everybody pays attention to from all over the world. It really is one of the great cities in the world, and it's always a pleasure to come back. I'm going to talk to you about REITs today, and I'm going to primarily talk to you about U.S. REITs, which I know them much better than I know REITs in most other countries. REITs have been a tremendous success story in the United States, and I'm going to talk about a few reasons why they have been very successful. And then I'm going to suggest that REITs as an owner and an operator of commercial real estate, it's a model that we should think about exporting around the world more. REITs have done great things for real estate in terms of being an allocator of capital, relieving some of the stresses on the banking system, and reducing boom and bust in real estate markets. Certainly that's been the story in the United States, and to the extent that we can take that and export it to the rest of the world and do more of the same in the United States, that would be a very good thing. So why don't we get started? I'm going to start with a quote from Ed Glazer, who's a Harvard economist who's has visited Singapore. And the quote is, "Singapore is a city innovating under constraint. You have a limited amount of land. You have to make sure you're not wasting it." I think everybody would agree with that statement. And I would only add that, and implicit in the statement is it's not only the land, but it's what you put on it. And the thing that I want to focus on today is it's not only that, but it's who owns and operates it. Okay, that's really the theme of the talk today in the context of REITs. But first, let's talk about who owns real estate around the world. But first, before I show you some numbers, there are basically three categories of owners. There's traditional investors in real estate. And that's until probably the last 30 years or so. Anywhere in the world you looked, the owners of real estate were the traditional private owners, individuals, families, moguls. And then starting in the 1970s, institutions started taking positions, I think first primarily in the United States. Singapore was a leader with the Sovereign Wealth Fund. Institutions started buying commercial real estate. And when we say institutional, we mean primarily private and public pension funds, endowments and foundations, insurance companies, and sovereign wealth funds. And then finally, although REITs have been around in the United States since 1960, I believe they've been in Singapore now since 2002. Other countries adopted them somewhere in between, some after 2002. But really, REITs have only really mattered, have gained critical mass since the mid-1990s. Before the mid-1990s, there were very, very small players in the United States. So REITs are a very recent phenomenon. But when you look around now, they really own quite a bit of real estate, and they own more and more real estate every year, as does institutional investors. So what are the numbers? The numbers are a little bit startling. These are very recent calculations. I got these numbers from LaSalle Investment Management, and they've been working on putting together these numbers for a number of years now. And maybe working from the grade level over, there's close to estimated there's close to $50 trillion of investable commercial real estate worldwide in U.S. dollars. That's a lot more than I had estimated. I remember I was trying to estimate, and I pulled this together for this talk. I hadn't done this exercise for quite some time. Maybe 10, 15 years ago, I tried to estimate investable commercial real estate in the United States, and at the time I remember my numbers were something like $4 to $6 trillion. $4 to $6 trillion in the United States, investable commercial real estate. And that would have probably put the world investable real estate at around 20 trillion. It's grown a lot in the last 10 or 15 years, $50 trillion. And most of that is privately held because the other two categories are institutional. That's $9 trillion. Those are the pension funds, sovereign wealth, etc. And then public real estate, those are REITs and other publicly traded companies. That's about $3.6 trillion. So when you subtract off the 12.6 that's estimated for institutional and publicly traded, we still have about 37 trillion. A vast majority of real estate is still privately held. But these other two bubbles are getting bigger all the time. In terms of what the U.S. is still the biggest player in terms of probably each of these categories, but the percentages vary. In public real estate, I would say that 40 to 50% estimated is the U.S. ownership share. So they're really by far the biggest players in terms of the REIT market. Institutionally, they're probably 30 to 40% is U.S. real estate, U.S. located real estate. I'll show you some numbers in just a moment. And then that would leave, once you do those calculations, that would leave about 25 to 30% of all real estate being in the U.S.
In this segment of the forum, it is my pleasure to introduce Associate Professor Sing Tian Fu. Professor Sing is the Deputy Director at the Institute of Real Estate Studies and Deputy Head of the Department of Real Estate at NUS. He sits on the Board of Directors of the Asian Real Estate Society and the Global Chinese Real Estate Congress. He serves as an editorial board member for the Journal of Real Estate Research, International Real Estate Review, Pacific Rim Real Estate Journal, and the Journal of Housing Studies, Taiwan. His research interests includes real options, real estate finance and securitization, REIT, and housing price dynamics. Professor Sing obtained his PhD and the Master of Philosophy degree from the University of Cambridge. Professor Sing, please.
Okay, first of all, thanks Tim for a very insightful keynote speech. So before we start, maybe let me introduce two distinguished panelists here. On my left, to the right of teams, we have Mr. Tan Seping. So he's the former CEO of Ascender Fund Management Singapore Limited and the manager of the Ascender Real Estate Investment Trust, Singapore first and the largest listed business-based and industrial real estate investment trust. Prior to that, he was also the Executive Vice President of the Real Estate Development and Investment of Ascenders Private Limited. He was responsible for formulating real estate development and investment policy, strategy, and plan across all country operations, and developing new products, offering and market for Ascenders. Before joining Ascenders in 2001, Mr. Tan was Senior General Manager for the Singapore Suzhou Industrial Park Development Company Limited, Residential and Commercial Business Group. He has more than 20 years of working experience. He has held senior positions in various banks, including the Bank of America, Standard Chartered Banks, United Overseas Banks, and so on. Mr. Tan graduated from the NUS with a Bachelor of Accountancy honor degree. He obtained his Master in Business Administration from the University of Leicester, UK. And to my left, we have Mrs. San Suan Eng. Suan Eng is the Managing Director and Regional Portfolio Manager of Northwood Security and over 20 years of global real estate research and investment experience, including 8 years managing real estate security portfolio with a focus on Asia market. Northwood Security was formed to combine the expertise of a very experienced real estate security team with Northwood Investor, a highly regarded property private equity investment and management firm. Headquartered in New York with seasoned research team in Amsterdam and Singapore, Northwood Security offers regional and global investment strategy through a variety of vehicles and pride itself on its deep fundamental analysis and market knowledge in order to maximize return for the client. Prior to joining the Northwood Security, Suan Eng held a similar position with E2 Capital Management? EII. Okay, sorry, EII Capital Management. As Managing Director and core portfolio manager for Asia. In 2012, 2013, and 2014, EII Capital Management won the prestigious Lipper Fund Award for Best International Real Estate Fund, in addition to others awards since 2006. Prior to joining EII, Suan Heng was the research director at Citigroup in Singapore. Over the course of 20 years career in security research, he has been recognized as a top-ranked property analyst in Asia Money, Institutional Investor, and Greenwich Associates Survey. Suan Heng earned an MBA and a BSc in Investment Management at NUS. So Suan Heng is one of our distinguished alumni. We are very happy to have a panelist consisting of economic and also industrial experts, both of the risk managers and investor perspective. Maybe we should start. I would like to invite Sir Ping to start by sharing with us, because hearing from team from the US experience, REITs tend to have, most of them, there's no debt ratio limit in the US, right? There's no borrowing limit imposed by the regulation in the US.
I'm sorry?
For REITs, there's no debt regulatory limits borrowing. Yeah.
Yes, there's no,
Yeah.
no rules in the road.
But in Singapore case, I think the MS had just revised the rule to set the standard one-tier kind of borrowing limit to 45%. But from my experience, we still find that a lot of REITs are still leveraged or geared at a very low, about 30 to 40% level. Maybe Sir Ping can tell a little bit about is it the policy that delivery to keep it low, or
I'm Chris from the Institute of Real Estate Studies, and I teach a REIT management course at the NUS. I've got a question actually still sticking on the leverage issue, and it's actually related to all three of you. And it's this, Suan Heng and Sir Ping were quite distinct in their responses to this leverage issue. Suan Heng can sell and buy whenever she wants, whereas a REIT manager must take into consideration longer term practical issues like banking relationships and relationships that are longer standing than the real-time movements in the share price. We have rather maybe confined ourselves in Singapore with this one-tier leverage threshold. Suan Heng pointed out the fact that Singapore REITs all cluster around 20 to 40%. I think the range is even tighter than that in reality. Are we confining our REITs and anchoring them into this very narrow capital management strategy, this very narrow leverage ratio range, at a time when we know that, firstly, there are very significantly well-financed private equity players who can borrow till the cows come home at very low and attractive interest rates. Does this really confine the acquisition, investment, and capital management strategy of REITs in Singapore? And should we actually just move away from this threshold, this limit?
Well, I guess I will look at that question from a slightly different angle, which is how does one make an investment decision? Whether do we invest or evaluate an investment opportunity independent of the funding structure. That means look at the basic fundamental attractiveness of a real estate investment opportunity first. And only when you clear that, and then you talk about how do you fund it. And I know this is very different from maybe private equity way of structuring deals, because you could be gearing up to maybe 90% or whatsoever. So that's my own perspective, and I'll prefer to do that. In fact, I have always been looking at investment from the angle that whether this property is is attractive, can withstand time and cycle, and we apply a theoretical or fixed capital structure to work out the MS. For example, say a 60-40 equity to debt structure consistently, and you take the weighted cost of capital through the cycles and not just at that particular point in time, because it could be pretty volatile in terms of both your equity cost as well as the spot debt. So that's my view. I don't know whether I directly answered your question, but I would look at it from that angle.
I think the way I look at it is, I think Chris is seem to suggest that 40% is a constraint on the REIT to grow, right? Okay. The way I look at it, yeah, I feel that when you say the 40% is LTV, loan to value, 40%, as a fund manager, I invest in property company. I can choose REITs, I can choose the operating company. A 40% LTV is equivalent to about 80% gearing to a property company. The way we look at the gearing concept, net debt to equity. So 40% LTV to me is already pretty high. I don't really want the company to be 70-80% LTV. Although I'm cheap, I'm not cheap, LTV is 40% to me is pretty high already, because if I compare to the operating company, it would be about 70-80% gearing, which is already pretty high. The other thing is, I know the private equity fund, they can gear 100%, but the customers are sophisticated investors. But the REITs target to the main the mom and pop as well. I think they shouldn't be too highly geared. I think it's a little bit irresponsible in a way, because at the end of the day, REITs are supposed to be safe instruments for retail investors as well. So my view is, I think 40% is pretty high as it is. Yeah.
Just a quick comment on, you raised some really interesting issues, and there's public policy issues. I think the point about competing with private, highly geared private equity, the U.S. REITs have the same issue, and so they've got to compete for assets with the same kind of folks. There's lots of highly levered private equity firms out there, and guess what? At this point in time, the private equity firms are winning, and they're the ones that are acquiring a lot of the assets. A lot of institutional investors are very aggressive, maybe not at the same leverage levels. And the REITs, as I showed on the board there, two things is that, again, I didn't show cycles, but low leverage tends to result in the lowest weighted average cost of capital for companies, and these companies don't have any limits in the United States. There's no imposed limits, yet 20 to 40% leverage is the sweet spot for companies in the United States as well, without a limit. And I think what the public markets like is and what shareholders are looking at is these companies are there. They're not private equity. They shouldn't try to be private equity. They're going to be there in the long run. And when some of these private equity firms blow up because of their leverage, REITs are going to be well positioned to acquire some assets on the cheap. So there's just going to be times in the market where REITs might not be quite as active as you might like, or as they might not like, or as they might like to be. But over the long run, at least the U.S. experience is that the good companies grow over the long run, and they can grow. A lot of the really most attractive growth is when the private side of the market is having problems.
Actually, I agree with you. I think if you allow the REITs to too high gearing, I think we need the REITs to adopt some discipline when they buy property. If it's a situation where it's so easy to borrow money, you borrow 100%, you go out and buy, I think at some stage those bad acquisitions are going to come back to bite you. especially in situation in Singapore where our REITs are externally managed, where there is a lot of incentive for company to buy for the sake of buying, because the fee to the REIT manager is a function of AUM. So the more they buy, the more they earn. So I think in a way, a gearing limit, I think will instill some kind of discipline in the way they buy property, hopefully. Although, I mean, they can come up with financial engineering, rent support, it can get around it, but at least I know 40% gearing. You can't borrow 100% in Japan at 2%. To buy something, a property in Singapore at 3% cap rates. Yeah, I think the 40% limit, I don't think it's a bad thing. I think it's a good thing.